Okay, good morning, everyone. So today is Wednesday, and we're week 7, and we're going to talk about some more on chapter 13 of the text, which is really a piece dealing with cost, volume, profit. And so, what is this entire section about? Really, it's something we introduced on Monday as being, I think, really sort of the heart of what we're doing in this course, and the fact that it's sort of situated in the middle is, I think, sort of appropriate. But it really talks about what accountants do on a day-to-day basis, but also on a project-specific basis in order to determine how profitable something is or isn't, and to what degree do we do more of one thing, less of that thing, more of some other thing, and it really is at the heart of financial analysis, frankly. And I know a lot of accounting majors people who do major in accounting who want to become financial analysts, which is really sort of a first rung of the financial industry. I know I started there as an analyst many years ago, and it really is an effort. It is a place where you really tear into financial statements and sort of pick them apart and determine relationships. And that's a lot of what we're doing here. So one thing, the syllabus, and I keep referring to this, but I defer the due dates on these a lot, and I know that sometimes people really like to sort of look at the syllabus that they printed off and back in August and say, okay, this is when things are due. But I defer everything for this week, homework quiz bonus, to next week, the 20th. So if you want to do it by the 13th, that's fine, but we're not going to really be done talking about it until this next week, week 8, that is. We're week 7 right now. And I know that we know these syllabi are sort of created by committee, and they were probably revised, I think, during COVID when everything went online. So obviously we can't have a week with no activity. So, which is good because we need a lot of time to cover CPP. It's an important concept. It requires lots of discussion. So we're going to do a lot of that today. And I think we'll get through the next couple learning modules within this particular segment today. And then when we come back next week, we'll delve a little bit deeper into some of the issues here. So I think where we ended up last time, let me sort of scroll up here a little bit. I think we ended up around here where we talked about mixed costs. And let me sort of adjust the screen a little bit. And this thing's not working. Hold on. So I want to try to make this as big as I can. Obviously, I've got some limitations here. So, all right. So we talked about, before we do that, though, let's kind of back up a little bit. We talked about this idea of having various kinds of costs. I'm going to go back to talk about the fact that where I'm trying to find a word. Oh, here we go. All right. So some costs vary in relation to total output level, or whatever the activity level is, and it's usually output. It's usually the quantity of outputs. But it doesn't have to be, because we can measure these things however we want, including the quantity of inputs, that is labor, machine hours, materials, pounds of materials, whatever. But it's usually, but however we are measuring it, it doesn't really make any difference, because a variable cost are those costs, those dollar costs, which vary in direct proportion with the level of output. That is, they go up more or less the same percentage and down with the same percentage, up and down. And I think it's important to realize that sometimes business activity fluctuates, particularly for those very cyclical industries that make goods that people don't want all the time. Like cars and whatnot. People buy fewer cars during downturns. So some costs change and some costs don't change. Those costs which do change we call variable costs. Those costs which don't change we call fixed costs. And just to sort of recap here, fixed costs are the same that remain within a relevant range. And I know this is an important concept here that we focused a lot on Monday. The relevant range is the activity where business sort of expects to be within a particular budgeting year, a particular fiscal year. And if you think about what the word fiscal means, it means really budget. It means, okay, if this next accounting period, whether it's January 1st to December 31st, or whether it's some other accounting year, we would expect costs to remain relatively constant or stable. There may be fluctuation, and we can deal with that. We can deal with maybe a 5% increase in variable costs More than that becomes a bit more challenging, but we expect them to be relatively stable. And this is why companies like to rely upon stable input prices and labor costs and all that, because the relevant range really determines how we budget and how we plan for our activity. So fixed costs are those costs which don't change. And some examples here are things like, well, property taxes, insurance, rent, but I would also include things like lease expense. A lot of companies lease equipment, vehicles, equipment, furniture, computers, home systems, I mean, you name it. These are all a fixed expense every month, and it's constant, it's understood throughout the accounting period what it's going to be. Salaries, it's almost the definition of a fixed cost. Supervisors and managers, those employees that we call non-exempt, are those workers whose pay does not vary with the level of activity. It's relatively fixed. And for right now, let's forget about the amount of bonuses and all that. That's something a little bit different that doesn't really play into the CDP analysis. So these are all examples of fixed costs. Now notice one thing, and I think I mentioned this on Monday, is that we're kind of zooming out here a little bit. Because when we talked in both chapters 11 and 12, we talked about product costs. We almost exclusively focused on product costs and said that we're talking about things like direct materials, direct labor, manufacturing overhead, as those three categories of costs, big cost areas. And that the other cost category organizationally is period costs, so-called because they sort of begin and end. We measure them at the beginning and end of an accounting period. Things like salaries, and they begin and end. Things like rent expense and whatnot, they begin and they end. And remember, these are income statement items. And what does the income statement do? It's a motion picture that starts and stops, and whatnot. The balance sheet is sort of forever. It sort of captures changes that are going on. It's sort of a snapshot. So that's really what's going on there. So if you were unable to be here on Monday, I just kind of want to bring you a little bit up to speed on that. But you can always look at the video that I posted on Monday for Monday's class. Okay. All right. So any questions so far before we get started? Any questions about where we're going in the class? What are the activities and whatnot? I see nothing in the chat box. So, okay, let's take a look at mixed costs. So we have fixed costs, we have variable costs, and now to confuse things a little bit more, we have something called mixed costs, which are a sort of a hybrid and involve both elements of fixed and variable. So what's going on here? And I love the example that the textbook uses of a U-Haul, because I think this is one that we can all readily grasp if we've ever rented a U-Haul or a Ryder truck, where they'll say it's $85 a day or whatever, plus 30 cents a mile, right? So we know we're going to pay 85 cents a day regardless of whether it just sits still and does nothing. That's going to be a fixed cost, right? But then we're probably not going to rent it to have it sit still. We're going to do something with it. And so for the miles driven, it's going to go up from there. And so the total cost is basically going to be here because it also includes the fixed cost. But keep in mind that the variable costs don't begin until we get to the fixed cost portion, which in mathematical terms is the intercept of this particular cost relationship. And I want to get into some math today and sort of bring you back to some areas of algebra. And I don't mean to complicate it, I really don't, but I think it simplifies things in a lot of ways. And like a lot of things in math, just take your time and pick it apart and sort of piece together the relationships. I don't think accounting is learned quickly. I really don't. And as long a student of accounting as I've been, I just don't think it works on a quick basis. I think you have to take your time, study things, and break it apart. So this is an example, and the example is that you've got a U-Haul, you've got $50, whatever it is a day, and then whatever the mileage is. And so as a result, total cost is going to be this, because the difference between everything that lies on this line and this line are composed of variable costs. And notice variable costs go up over time. And we're assuming that it's a linear relationship that is a constant rate of change, which is what slope implies, a constant rate of change on a linear function, that is, over time as the activity level increases. In this case, it's miles. So remember, activity, we talked a bit about this on Monday, this idea of how do we measure cost versus activity, and activity can be all kinds of different measures. It's not limited to miles or something countable in units. It can be dollars. The example that was given on Monday was sales dollars in a retail store. And how do we track activity based upon sales dollars in a retail store? So that's a dollar figure on this axis, okay? Or it could be things like, one of the examples given in the text was dance lessons given, right? Or whatever. And some of the examples I threw in here because they're unique to a particular industry are things like revenue per available seat mile when it comes to airlines. And all these seats are going someplace, whether there are people riding in it or not is an issue, right? Or revenue per table, or revenue per available room in the hotel industry. All these are examples of metrics that we might use as activity drivers on this horizontal axis. And hopefully some examples that I'll give you are a little bit more clear as to what's going on. So in my language here, in green, the green is my own writing here. And both functions begin at a common vertical intercept, which corresponds to the fixed cost element. So variable cost doesn't start at 0 in this case. If there were no fixed cost element, it would start at 0. It would start at the origin, boom, and go up. And it would be mostly vertical, or I'm sorry, mostly linear, I should say, within the relevant range. And again, the relevant range is where we expect to operate. Then if we're, what was the example I used on Monday? If we're making refrigerators or whatnot, we're making 200,000 refrigerators, microwaves, or whatever. We're probably not going to be looking at 20 million the next accounting period. That's probably not what's realistic. It's what is coming up in the very short term is really what we're getting at. Long term, all bets are off. And in the long term, everything is up in play. And I know that I always like to talk about the long term as being sort of a kaleidoscope. That you kind of turn, everything is moving. And that's a lot of what accountants are there to do, is to try to figure out how things are moving, why they're moving, and what it all means. And that's kind of the fun part about it. And I've known many accountants who really like this particular area. And I think it's really sort of the heart of what we're trying to do here. Okay, so let's talk about some examples of cost. I know this is when I first saw this, because this is, I think, unique to this edition of the text, I thought this is a pretty nasty slide, but it's really not. If you think about it, you've got some listing of costs. This is a hypothetical company called Helen & Company, and they've got two different levels of production, 10,000 units and 20,000 units. And then these are the cost, these are just simply items of cost kept corresponding to these output categories. And so let's take our time and let's sort of tear into this a little bit. Direct material, all right, so first of all, before we do this, we have to understand that 10,000 units is half of 20,000 units, right? That's pretty obvious. So we would expect those costs, which vary with the level of output, to also be twice, because remember, it's variable unit cost should be constant, even though total variable cost will vary, obviously, with the level of production. So direct materials at 10,000 units was $20,000, at 20,000 was $40,000. Well, that makes sense. We can obviously classify that as a variable cost. Direct labor at 10,000 units was 17,000. It's 34,000 at 20,000 units. That's double. That makes sense. Same with indirect materials. So those elements, I think, are easily identifiable as variable costs because they vary in direct proportion. And remember, the thing that we talked about on Monday was this idea that variable cost per unit is simply this idea that you've got variable cost over the quantity of some output. And I put a little subscript of quantity of output in order to differentiate it from the quantity of sort of input. And variable costs are a dollar figure, and quantity of output is a numerical figure. And everywhere, and I know I've said this a gazillion times now, whenever you have a dollar figure multiplied or divided by a number, you're going to end up with a dollar figure. And so that dollar figure is a cost per unit. So it's the variable cost per unit. And we're going to say it's relative, we're going to say it's fixed, okay? And it's going to be fixed here at, looks like $2, right? It's basically double that. So in other words, what we're trying to do is isolate those costs, okay? Questions so far about this? Because I know I've got these arrows going places. I know it's kind of nasty. Let's talk about fixed cost, then we'll come back to the final bit here, mixed cost. So fixed cost, depreciation. which is simply a financing cost that we spread out the cost of some acquisition of depreciable assets over some period of time. At 10,000 units, it's 4,000. It's also 4,000, 20,000. Well, that is by the definition of, that's the very definition of fixed cost. Does not change with the level of outcome. Rent expense, that was the one we specifically called out as being a fixed cost. It's not going to change the level of output. And it's just like renting an apartment. Whether you're living there or not, you owe the amount of rent. So it doesn't make any difference whether there's activity going on or not. That's what rent expense entails. It's fixed cost. Doesn't matter what's going on. So if you're renting premises for your businesses, and a lot of businesses do, and by the way, there are a lot of reasons why companies would rather rent than own. Maybe discussion for another day, but it's going to be a fixed amount. It's going to be independent of the level of production. And by the way, and I've said this before, I think that some companies will shut down at certain points of the year, particularly manufacturing operations, in order to do things like maintenance on all the stuff that's going on. 11 months of the year, people are banging into things. They're using things up, and things are getting dirty, and they'll shut down. And usually pay their workers, so the workers are happy. It's usually December, usually end of the year, but they'll clean things, they'll maintain things. You have a maintenance crew coming in doing all these things. But they're producing no output, by the way, but the rent goes on. And the lease expense on the equipment goes on, and depreciation goes on, insurance goes on. All these things are independent of the level of production. Okay? So variable and fixed, the red and the green here. All right, here's where it gets a little bit dicier, but we're going to take our time on this because this is really the main event for today, is mixed costs. You've got maintenance, and at 10,000 units, it was $8,000. As we jumped to 20,000 units, it only went up to 10,000. So that is not a proportional increase. And the same goes with utilities, where at 10,000, we incurred 3,000 costs, and we only had 5,000 of an increase in that production. So those are obviously mixed costs. And there's a fixed cost element underlying this, obviously. And I can probably tell you the majority, certainly in the case of maintenance, just looking at this by eyeball, a lot of this has got to be fixed cost, the fixed cost proportion. The same goes really with utilities, although to a lesser percentage. So that's what mixed cost is. It's simply a combination of fixed and variable costs that are dealing with, because it's the nature of the cost relationship. And remember, inputs create cost. I can't say this enough. Inputs create cost. All of these are inputs and cost. These are the inputs. These are what they are: labor and indirect materials and whatnot, in order to make an output. So these are the inputs, and these are the cost of those inputs. And remember that there's a great slide back in chapter 11 that had the flow of production of physical items as we go from start to finish on a physical good. And then we have a parallel flow of the dollar costs. And we're absorbing dollar costs as we go along. And that's really what's going on here with a lot of the costing of goods that we do as we progress. Okay? So that's essentially what's going on. So some vary, some don't vary, and that's really the nature of those costs. Okay, any questions before we move on to talking about what do we do about mixed costs, and how do we sort of deal with the issue of mixed costs? Okay, well, let's, if you do have questions, you can, again, feel free to just jump in. It's not a big deal. So, all right, so we've got, just with this example here, we had mixed costs. We had two in particular. We had maintenance and we had utilities. And we really can't determine, just by looking at this, we really don't know to what degree these are fixed and which are variable. And why do we care? Well, we care because it's going to impact the whole analysis of what's to come later. And that's something called break even, which we, I think, opened the door a little bit to on Monday, where break even analysis is this sort of a view that says, okay, and it may not be for the entire company, but maybe for an individual product, where we say, okay, we produce this amount of output. What amount do we need to produce to break even? And fixed costs versus variable costs, that determination really makes a big difference. And we don't expect a lot of the companies that we would work with in a publicly traded setting, which is kind of the orientation that we have in accounting coursework, to break even. We don't think that they're going to break even. But new products may not break even for some time. because of the fact of we need to get to a certain volume level. That's where the V comes into play here. So it does matter how we are approaching the issue of fixed versus variable. And what do we do about costs which have combinations of both fixed and variable? So let's dive in here. Let's do it. And we're going to talk about one method, and we'll get to another method a bit later, called the high-low method. This is really a much more simple method than what it looks like. And the math is really not that much more complicated than basic algebra that you might have seen before. I know that we oftentimes say to students that accounting is really not math. It involves math, but not, unless you're really doing some high-level research, it doesn't involve that high-level math. Well, it's basically algebra at its worst. Nothing like calculus is not really involved. I may get into some calculus if you like that, but it's not something at all that we want to focus on here. What does the high-low method seek to do? It basically takes cost at high and low levels, and we take cost and activity level both, and we take these differences and we arrive at a variable cost per unit. That's what's really getting at. So the key thing is here, if we can arrive at one piece of the puzzle of the equation of cost and revenue, then we can figure out all the other pieces of the puzzle. So we're going to be like accounting detectives here. We're going to sort of tear into it because we're going to find out, we're going to discover one problem, we're going to solve one problem using the clues that we're given, and then we're going to figure out the rest of the problem, and we're going to create an equation that will tell us what is the cost equation for this company at a particular time, okay? Because in the long run, things are going to change, and we said on Monday, all costs are variable in the long run, so fixed costs are only fixed in the very short run. So that's what the high-low method is, as a general idea. As an example here, oops, let me see, let's do the answer. So as a general example here, the equation that we would use is this. So we would take the change in total cost of the high activity versus the low activity, which is basically the difference between those. The change in is usually a subtraction problem. Something minus something is the difference between those things. Remember, difference is the difference in those divided by the difference of the high minus, and here we have the term minus activity level. And I'll break this out a little bit more quantitatively in a second. And that's going to give us the variable cost per unit, or unit variable cost, which is essentially this. Now, why do we need to know this? We need to know this because it tells us, and we're going to come back to this quite a lot in this class, because it's going to be an issue of where if we know what it costs us to make a particular good, whatever it is, then we can know whether or not we want to do more of that good or less of that good when we bring into things like revenue to the picture. And again, this is how managerial accounting sort of differs from cost accounting. Cost accounting is sort of a subset of managerial accounting, because managerial accounting also includes things like revenue. Okay, and the revenue picture we're going to focus on a bit later. So anyway, change in total cost divided by the high-low difference divided by the change in the activity level at the high and low difference. Okay, so here's an example, and I'll sort of tear into this a little bit. So, all right, Metro Transit is a bus company? Yeah, bus company. And so they've got data for 6 months. Okay, so it's not a year, it's not 10 years or whatever, it's 6 months. And they want to know, what does it cost us to drive a mile? Pretty good thing to know, right? If you're a bus company. I don't know if it's a public company or private, doesn't matter. And by the way, a lot of governmental organizations would like to also answer the question, what does it cost us to drive a mile? So in this case, we're going to isolate two things here, the high and the low. So it looks like April, we've driven 50,000 miles, and we have a cost of 63,000, and it's highlighted here, so it's easy for us. And then in January, we've driven fewer miles, and we have the fewer cost. Now, this is not accidental that the activity level and the dollar figures are higher in April than they are any other month, and that the fact is they go together, because a lot of this cost is variable cost. And then it's not a secret that the lowest activity level also involves the lowest cost. That's not a secret at all. In fact, we're going to extract from this data the fixed cost element, which does not change, but we don't know what it is until we do the math. Okay, so if you go back to the formula before, we're taking the difference between activity levels, change in total cost, high versus low, divided by the activity level, high minus low. That's in this case miles. We're going to get a unit variable cost. And so in this case, what do we have? So the math here is relatively simple. I don't really have to. I hope I don't have to write it out. So it's the high 63,000 minus 30,000 is 33,000. That's the numerator. And the low is dollars, or I'm sorry, activity, 50,000 minus 20,000, which is 30,000. 33,000 divided by 30,000 is $1.10. And again, I come back to this idea of a dollar figure divided by a number is going to give you a dollar figure. So we're going to say it's $1.10 per mile. And so we've isolated it based upon a high-low method. Okay. And that's really what's going on there. So, and just to kind of give you a little bit of, if the math is something that you want to see here, I'll kind of give you a bit of a methodology. And I don't really get the text. Really got into as much as what it might have, and that is the whole notion of how we get to variable cost per unit. Now, we're not done talking about high-low at all. But what I do want to talk about is this idea of how we get variable cost per unit. This is really an interesting idea here. So variable cost per unit, so it's simply a dollar cost per unit, but it's the variable cost portion that's absorbed into it. And it's simply made up of this. And follow along with me here. It's the change in total cost divided by the change in quantity. Okay. The little delta symbols here, little triangles, are mathematical notation we use everywhere in every discipline, every academic discipline I've ever come across that deals with change in something. It's simply the change in something. And we use a lot of Greek symbols, but don't be freaked out about that at all, because what it really means is this. The change in total cost here is the total cost at the high level minus the total cost at the low level. All delta means is new minus old. That's all it means is new minus old, right? Or one thing minus another. Divided by the quantity at the high minus the quantity at the low. And that's really all that's going on there in this particular formula. And what we're going to end up with is, we know that if in the relevant range of activity, we're going to have a situation where we've got, and again, we want to put activity, which is usually output. And it's not always, but I think output is a variable on the horizontal axis makes a lot of sense. We've got the origin here, these axes run forever, right? And we got dollar figures on this axis right there. And that when we talk about this notion of what variable costs do, if we're just isolating variable costs themselves, we're saying that they start at the origin and they go up in a more or less linear fashion, like, oops, not much ink in that. Okay, well, that's a bad marker, sorry about that. I guess we don't know what we got until we get there. So it's going to look something like this. It's going to be more or less linear. I don't even know if you can see that or not. These markers, sometimes these markers are not that great. Anyway, that is supposed to be one straight line. It's kind of a fat one, but this is essentially the variable cost function. And that furthermore, what's important about this is that if we go back to this idea that variable cost is linear, then what can we say about this? If variable cost is linear, we can say that we go between one level of output and another. We're going to have some change here, and that change really represents the slope, right? If it's between, I don't know, 10 and 11 units or whatever, right? It's the slope. And the slope here is equal to the variable cost per unit. And I want to come back to this idea of a linear equation. And I know that I'm kind of getting to the math here a little bit, but I think that it helps to really understand the math. And and I realize that students come to us with all kinds of different math backgrounds and whatnot. So if you're a little bit concerned about it, don't be concerned about it. Let's just take some time to deal with it. The generic formula for a linear function is this, right? Y equals mx plus b, right? Y being every value that lies upon this axis, x every value that lies on this axis. We may rename it as dollars and quantity and whatever. We've got all kinds of different ways we can measure or evaluate these, but they're the same axes. And one unique variable of x refers to one unique variable of y. B is the intercept. In this case, the intercept is 0, so there is no value. It's simply y equals mx, right? The intercept is 0. Anything plus 0 would just cancel it out. So in this case, what do we have here? We've got dollars equals slope times quantity. Okay? And the slope here is variable cost per unit times units themselves. And that's going to give us the dollar figure. Okay? And the dollar figure here is simply the dollar of cost. And the dollar of cost is really, let's just go ahead and say that's variable cost. So variable cost per unit times quantity. Variable cost per unit times quantity. And kind of remember that because we're going to be getting into this a bit more as we sort of approach this. And so again, we intercepted the intercept is the origin itself. So this B doesn't make any difference. It does when it comes to mixed costs, but we'll get to that a bit later. Okay, we'll come back to that, particularly when we have some more examples of how we're sort of pulling this apart. Notice too, what does this formula look like if you're into math? Doesn't it look a lot like this thing right here, where we have slope equals y2 minus y1 or x2 minus x1. If you've seen that before, that's the point slope formula for the slope of a linear function, right? Isn't that what we're doing here? Exactly what we're doing here. And what is the slope? Variable cost per unit. And variable cost per unit is the slope of this particular function. Okay. And without getting, I know that sometimes it seems like we're getting off into the mathematics of this, but again, math is just a tool that we're using to apply to this particular analysis. And why is this important? It's important because slope represents the rate of change in one variable in relation to the other. And by the way, if it costs you a lot per unit in relation to some other, then it's going to be a steeper slope. If it costs you less, it's going to be a flatter slope. You would want to know that. You really, really would want to know that. In other words, if it costs you very, very little to produce a unit of output, then maybe that's one consideration versus does it cost a lot to produce one unit of output, which is really what variable costs relate to. And fixed costs, for our purposes here in CVP, are going to be mostly just accepted and not really easily manageable. Yes, you can lay managers off, you can sell equipment. I guess you can do that, right? Yeah, you can do that, but it's got problems of its own. Okay. All right, so that's what's going on there. So any questions about this before I move on here? Because I know that sometimes the math is something that is a bit problematic, but it shouldn't be because these are basic ideas that we deal with all the time. And from the accounting standpoint, yes, you probably would use a whiteboard as an accountant or as a financial person in real life. You probably use an Excel spreadsheet, which will do all this stuff for you. And we'll do it faster, and you can move numbers around, and you can do a lot of things, but it's the same concept. You're going to be using the same kind of numbers if you are involved in this particular activity. And again, CVP analysis, if we are sort of zooming out to what the purpose of it is to really determine what is it we're doing and why is it we're doing it, and should we be doing more of it? Should we be doing less of it? Should we be doing something else? Okay. All right. Okay. So let's move on here. And I know this is not a great system for going back and forth with the screen and whatnot. That's kind of what we're dealing with here. And this is sort of a live TV kind of deal here. So all right. So this is an example of the bus company. So does everybody see how we got to this variable cost per unit? This unit variable cost, and is really it says, and what does the slope of the function tell us? It tells us what is the rate of change. In other words, if we drive one more mile, we're going to incur $1.50 cost. If we drive one less mile, we're going to incur $1.10 less in cost. So that's important to know. But that's not the end of the story, obviously. So, because what we're trying to get at is, okay, is we know what the variable costs are, but what are the fixed costs? So in this case, and I hope we can see this, I know this is, even those in the classroom may have a little bit of trouble seeing it. Hopefully you can, on the video, see it as easy as well. And again, these are all in your book, of course. But it's this, and I love the fact they dropped it into an Excel spreadsheet. Speaking my language, okay? It doesn't matter which way, take the high or the low, we can simply drop these activity levels. Remember that the high activity is 50,000 miles, times $1.10 is 55,000. The low activity was 20,000, multiplied by the activity level of or cost per unit of $1.10, 22,000. And we go back to the costs, total cost. Total costs include fixed and variable costs. The high was 63,000. So if we take out the variable cost portion, 50,000 times $1.10 is 55,000. The total cost was 63 minus the variable cost is 55 gives us 8,000 as a fixed cost. Okay, but we can use either formula because the fixed costs aren't going to change. That's the nature of fixed costs. And so the total cost at the low was 30,000, and we had the variable cost portion of the total cost was $1.10, which is 22,000. 30,000 minus 22,000 is 8,000. It's not at all a surprise or whatever that we have 8,000 as fixed costs. So in this case, why are we doing this high-low method? It's to try to isolate fixed cost because we can't always pull it out from this particular data given. But it's also important to know what the variable cost per unit is because we need to know from a decision standpoint, do we do more or do we do less, right? And there are cases, and we're going to be getting into in this class, there are occasions in which organizations will be challenged with doing more or doing less. And the question is, do we want to do that? Do we not want to do that? And I know that it kind of goes against maybe common sense even, that says that, well, we'd always want to do more work. We always want to get more pay. But do we? And that's going to be an issue that we're going to be getting into a little bit later, but we use these basics of CVP analysis. And I use the term CVP because everyone who uses this is very much versed on this particular idea. Okay. All right. One other thing here, and I want to sort of round out the discussion of cost here because I want to talk about, and mind, and you want to make sure that you've got this captured somewhere in your notes because I don't know that the textbook really gets into it as much, but my experience is that it's better to kind of be more involved in this than ever, and that's the idea of total cost. So if we think about what, I guess this is not. So if we take a look at what total cost is, all right, remember inputs create costs, right? So, and all these costs are what we would call total costs. And total costs are really combined, are a combination of two factors, two very broad categories, fixed cost and variable cost. Should not be a surprise at this point, fixed cost plus variable cost. But as we know, variable cost is really, fixed costs are one thing, but variable costs are basically composed of fixed cost plus variable cost per unit times the number of units, which we're going to call Q. Okay. And why do we want to break this up? Why do we want to factor this out as in terms of variable cost per unit times quantity? It's because sometimes we might not know what the quantity is, but the variable cost per unit is going to be relatively fixed. We can sort of lock that down, and we can lock this down. And the variable here is this. And if we move this around, we can determine what the total costs are going to be. And this is where we get into lots and lots of scenario analysis that says we can move things around and determine what's happening. So kind of be aware of what's going on here. All I've simply done here is taken what is a very basic cost equation that says we've got two elements of cost, fixed, those costs which do not vary, and variable, those costs which do vary. Fixed costs are going to be fixed. There's not much to say about them. They are what they are, at least in the short run. Okay, and plus the variable cost per unit times the number of units. And again, the Q here is units, okay? Q is, and these are units of output in this case. Okay. So that's really sort of an elaboration of what's going on there. And I'm going to sort of build on this a little bit because we're going to talk about some more specific examples relating to high-low and why high-low is needed. And by the way, high-low is it's a methodology, it's a technique that's been practiced a lot of times. And I know before I came to C&M, I taught in a graduate program, and we had a manager of McDonald's. She was a regional manager, and she said they use a high-low method for a lot of things that they do. It's a real measure of what it costs to do certain things. And in particular, we were talking. I guess this is back when the hamburgers were $1, right? It's not been that long ago, right? You know, the dollar hamburger. I think what are they now, $2 or whatever. But the question on my mind was, why would you do a $1 hamburger? Are you making any money? She said, well, if you look at the high and low, we are, because we are selling a lot of those hamburgers. We're not making very much money per unit. And our variable cost per unit is relatively high, but we're selling just a tremendous quantity of those. And they arrived at it through a high-low methodology. And so this is not theoretical and overly academic. They've got some real specific uses. Okay. Let me see. I don't see any messages in the chat box, but if you do have questions, feel free. Those on the Zoom link to chime in if you want. Okay. All right. Well, let's go back to this example here. So we've got different scenarios. We've got 20,000, 40,000, yada yada. We've got different amounts of activity, and they're all nice round numbers and whatnot. But what we don't have is any issue where they've driven 45,000 miles. We've got all kinds of other variables, and so in this case, why is this particularly useful? Because we've got a different example, and it's a what if. And the what if is, what if we did 45,000 miles? What would be the costs? We know, and we're saying maintenance costs are the only element of fixed costs. Okay. Whether that's realistic in real life, I don't know. It doesn't matter. We're saying 8,000 is the fixed cost element, and we know $1.10 per mile is the variable cost per unit being the miles driven. Remember, not every output level is a toaster or it's a hairbrush, right? It could be a service, in this case, driving miles. So it's $1.10. So in this case, what do we got here? We've got $1.10 per mile. We got a fixed cost component plus the variable cost component. So 45,000 miles, then what do we got going on? Well, we got to include the 8,000 first of all, and then $1.10 times the 45,000. We go back to the formula I just gave you: fixed cost plus fixed cost plus variable cost per unit times units, and that's 49.5, and so 57,500. That's why this method is needed. It's a way to isolate the variable cost portion of total cost from fixed cost. Okay, that's simply a way to do it. That's one method by which we would sort of isolate those particular costs. And by the way, we could fit a line to this if we wanted. And high-low is not the most perfect method, but it's a pretty good method, and it's the one that, believe it or not, is the least mathematically involved, and most of us are able to sort of handle it with only a little bit of minor discomfort. But you could fit a line that would graph that, and you could do all kinds of what ifs: 45,000, 60,000, whatever, and you could estimate what amount that you're going to be incurring in terms of cost. In this case, it's just a cost incurrence. We have no idea what they're charging per mile. Hopefully, it's something greater than $1.10 per mile, but again, we don't really know, and that's not part of the puzzle, but it is an important piece of the puzzle that could be given at some point. Okay. Okay, and just to sort of, I want to, without one thing that I really think is important in this particular example, I'm going to kind of take this up a little bit here. Is I think it's important if we just take that last example, that last scenario, and just plug it back into our formula here. I think it makes a lot of sense. And so, in this case, what are we talking about here? We're talking about total cost equals fixed cost plus variable cost, which can be further expanded upon to fixed cost plus variable cost per unit times quantity. In this case, let's go with this example, total cost equals the fixed cost element, which is 8,000, plus the variable cost per unit, which is $1.10, $1.10 times the quantity of output. And that's the formula. And by the way, this is the formula for that particular bus company's situation for whatever the relevant range is. I know that when we say relevant range, we're saying that, okay, we're doing 45,000 miles. If it's 800,000 miles, that's probably this guy's going to go up a lot. There's going to be more buses or whatever, and that sort of thing. But that's what's essentially going on there. Okay. And so all we're doing is plugging in 45,000 here. And we're arriving at the total figure. I forget what that is, but that's the formula, right? And if we go back to this methodology of y equals mx plus b, right? Well, the total cost is the y. And I'm going to sort of, what I should probably do is sort of invert these a little bit here. Let me find it. Because I know that sometimes the way we express these are a little bit different than the way we do in algebra. So y equals mx plus b, y is also equal to b plus mx, right? All I've done is invert these guys here. So y is total cost, b is the intercept, which is fixed cost, m is the variable cost per unit, and x is the quantity of units. Okay? So that is really what's going on. That's the way to think about this. I know that sometimes the way we, just as an accounting and finance, we like to start with sort of fixed cost because that's sort of our base that's not going to change. And then this is the portion that is going to change. And I know for whatever reason, mostly because of ordering issues and exponential matters, that we would put mx on this term here, then b here. But we can invert that and make it look like that. B is the intercept. So in this particular case, we would start with 8,000. It's the intercept on the cost axis. In this case, it'd be 8,000, right? Because if we do 0 miles, we're going to incur 8,000, right? So that's an example of what mixed costs are all about. Okay. So does that make sense? Yes. No. Okay. All right. So let's kind of move on a little bit here and talk a bit about what comes next here, and just continue our high-low discussion. And I really think that chapter 13 is an important enough chapter that I really do not want to rush and go quickly on, because I think it really requires a good amount of explanation at times. Okay. Okay. Well, speaking of linear functions, here's what we've got. We've got 8,000 as the intercept here. It's not marked as 8,000, but we're going to assume that that's what it is. And we're going to go upward at a slope of $1.10 per mile. And the activity level is on the horizontal. The dollar cost is on the this level here. And for I don't know why they say maintenance cost, because it's probably maintenance is kind of, you would think of it as being something that's a one-off, but it's all cost essentially. And so as a result, you've got this nice linear function. But notice what you've got here. This is important. If you plot the data that goes back to the original scenario, it's this thing here. And if you plot these, right, this is x, y, x, y, x, y, coordinates, right? Or half of an ordered pair, right? The x and y, x, y, these are half of the ordered pair. You plot these things on this graph, and they don't line up perfectly on the graph itself. And so you think, okay, well, is this a very good function? And by the way, just by eyeballing this, I would say it's a pretty smooth function. They're all, if you've taken stats before, you'll talk about this idea of dispersion, that if you have a value here, if they're all over the place, like here, 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 you might still be able to draw a graph through it. But when you've got data that are all over the place, and it's maybe not, it's the best fit, but the best fit is maybe not telling you anything. Here, we actually have the virtue of having being a good fit. In fact, we have a couple points, maybe even 3 or I guess 4, which are on the function itself. Even though we got some dispersion. So it's a pretty good fit. But we're lucky here because it is a good fit. So and I think we can hang our hat on it. And I think sometimes perfection is the fantasy. Instead, we are looking for good enough. And this is probably a good enough function for us to plot what's going on here. So it's not a big deal at all. But let's talk about, and we're going to get to a different method here, which the high-low method does not necessarily seek to get into. So a quick question here to review. Mixed costs consist of a variable cost component and fixed cost component, a fixed cost component and a controllable cost. Yada, yada, yada. Well, the answer is A. It's going to be variable cost and fixed cost component. So those are what are going on there. Okay. I want to spend a little bit of time, and I don't often do this on the do it because these are sort of summation, sorts of like an argument would make a summation argument. But I do think it's important for us to talk about this one. Sometimes I just kind of talk about these briefly and don't spend a lot of time. But I think in this case, it would be helpful for us to use this example. It's a different company, different scenario altogether in order to answer the questions. What are the variable and fixed cost components using the high-low method? And then from that, can you construct a cost equation? And because we know it's going to be a linear equation, it's going to be the cost equation is going to be linear. And then estimate some cost if we do 8,000 units. 8,000 is just sort of something that's hypothetical, but let's do this. Okay, so here's what we've got. So we've got a number of different pieces here. We want to compute A, B, and C, the variable cost and fixed cost components using this method. And I know this is a bit unfortunate in the sense that a lot of times if I were in a physical classroom and we were all here, I would just go to a different board, leave this up here, but I really can't do that. So what we have to do here is sort of focus on the high and low, and then just kind of remember what it is. Obviously, if you're watching the live video, you can pull it up on your, I'm sorry, on the recorded video, you can pull it up later and refer back to it, but or have different windows, whatever. But in this case, we're going to find we've got 5 months of data for whatever we're producing. It doesn't matter what we're producing, and we've got to identify the high. Well, I mean, it doesn't take a genius to see this is going to be the high, and it corresponds to the high activity level. This is going to be the low, and that corresponds to the low activity level. So what do we got here? We've got high and low, high dollars, high activity, low dollars, low activity. So we've got all we need in order to run with this problem, don't we? So why don't we run with this problem and see what we end up with? So let's do this, and I think it's just another example. It's just another way of looking at how we do this. And again, I probably ought to say this more, but I think sometimes people benefit from doing some of the problems in the back of the book that aren't for credit. Particularly if you're struggling with something, there's, in my mind, no real substitute for doing some of the problems and whatnot. I do think it's a necessary thing to do, and it's a helpful thing to do. And the help is really coming your direction here. Okay. All right. So let's do this problem, and we've got this is the company that's manufacturing. So let's start with this. We're going to do part A here. Okay. And we're going to first calculate variable cost per unit. So variable cost per unit, again, I'm going to kind of zoom out here. It's the change in total cost divided by the change in quantity, which is nothing other than this. It is the difference between the high cost and the low cost divided by the quantity of high and the quantity of low. Okay, and that's really all that's going on there. If this looks nasty, don't think of it as nasty, just think of it as just numbers to plug in and take it sort of one step at a time here, okay? And so let's solve the problem here. So what is the high cost? It's given, we don't even have to calculate it. 14,740 minus the low cost of 11,100 divided by the activity level, which was high at 9,800 minus the low activity of 7,000. And we're going to get the numerator reducing to 3,640, the denominator reducing to 2,800, and it's going to give us 1.3, or because it's a dollar figure divided by a number, it's going to give us a dollar figure and that's the variable cost per unit. Okay? And that's how we solve the formula for the variable cost per unit. Because remember, that's the first step here in isolating variable cost from fixed cost. We may not know fixed costs necessarily, and but if we know the variable cost levels based upon these activity levels at the high and low, and by the way, the high and low just simply says we're going to sort of bracket everything at the high end, the low end, and everything in between. And is it a perfect system? No, but it's when the relationship is fairly linear and fairly strong, it's probably pretty good. Okay. So now what do? We plug $1.30 into either cost equation. Okay. We can do either one. And I'm going to prove it both ways here just to show how strong this relationship ought to be here. So remember, and these equations are going to be, or it's going to be the high and low both. So let's plug them into both cases here. Remember, we're trying to isolate fixed costs. So total costs are composed of fixed cost plus variable cost. Variable cost being defined as variable cost per unit times the quantity of output in this particular case. And so in this case, we know we're given total cost here, and let's just take the high scenario first, which we'll call H. Okay, and the total costs are $14,740. We don't know what the fixed costs are because that's the variable. We know the variable cost per unit is $1.30. We also know the quantity, which is 9,800. Okay, that's the formula for this. And let's just kind of do the math here. So 14,740 equals fixed cost plus what is $1.30 times 9,800 is 12,740. We subtract 12,740 from both sides, and we should get fixed cost of $2,000. That's $2,000. Okay. That's the high. Let's prove this on the low. And again, mathematicians like to sort of prove things. And so we'll take the low cost, total cost is 11,100 equals fixed cost, which again is the variable because we're assuming we don't know what it is. And it's $1.30 times the low activity, which is 7,000. Okay. That's the formula. And so as a result, what do we get here? We have 11,100 equals fixed cost. $1.30 times 7,000 is 9,100. We subtract 9,100 from both sides, and we get fixed cost of 2,000. Okay, so that seems to work. So now we have isolated the fixed cost element of this particular production activity for whatever time period. I guess it's a 5-month time period that they're looking at here. And that's what we're really trying to get at, okay? All right. So we answered A, and A, I think just asked us to get to, what was it? Actually, what was A asking us here? Because I want to answer this specific question. It was compute the variable and fixed cost components. Okay, I think we've kind of done that. And B was write the cost equation, which I think we've kind of done. I know this is kind of messy here. And then C is estimating the total cost if they produce 8,000 units. Okay. All right. Well, so here's the equation. Actually, no, we probably haven't quite closed the deal on the. So in A, we get variable cost per unit of $1.30. The cost equation, we've done it, but we haven't really specified as being the equation, I don't think, and that is total cost equals, remember, fixed cost plus variable cost per unit times quantity. In this case, the equation is going to be total cost is 2,000 plus $1.30 times quantity. And that's the equation, okay? Now notice that we've got a couple different variables here. And you might think, well, wait a minute, we haven't really gotten this all the way down, but we really have, because the variable that's going to change here potentially is quantity. If we produce more or less, whatever, this is going to change, which means this is going to change. But this is not. And by the way, this is not going to change. The $1.30 is not going to change because we said variable cost per unit is mostly fixed. So that is really the equation that we want to go with here is 2,000 plus $1.30 cubed. And then the final piece of this is part C, which asks us, okay, at 8,000 units of output, what is the total cost going to be? All right, well, let's do that. Let's use this basic formula, right? Total cost equals 2,000 plus $1.30 times, in this case, what is it, 8,000? So let's do the math here. 2,000 plus $1.30 times 8,000 is 10,400. So total cost at the output level of 8,000 is 12,400. Okay. And that's really what's going on. Once we have isolated and determined what the cost per unit is at the variable cost level, that's what the high-low method really seeks to do. So, and it's really simply a matter of pulling out variable cost per unit first. Okay. All right. So, any questions? I know we've done kind of a lot of math here today, and I want to make sure we're all kind of clear on it. And again, I think Chapter 13 is one that is really critical to the whole enterprise of managerial accounting and its sort of tie into finance. It's the idea of saying these various what ifs, and these what ifs are coming up all the time in business. Okay. All right. Obviously, we've all got this on video, so I'm going to usually during the face-to-face classes, I say, okay, let me go take a picture, do that, you know. But we're going to go ahead and move on a little bit because we've got just a few more minutes left, and I do want to sort of get through the rest of this particular section here. So anyway, these are the $1.30 per unit fixed cost. Okay, these are the answers to this. So A was $1.30 per unit, which we solved in class. Fixed costs were 2,000, which we solved. Cost equation 2,000. So this is basically cost, or total cost is fixed cost 2,000, variable cost per unit times units produced. So that's the cost equation. Okay. For this set of data given, and so we have five sort of ordered pairs, and then total cost at 8,000. That was the scenario given. Was if we did 8,000 units of output, what would the total cost be? And we're saying it's 12,400 based upon this information. Okay. All right. Any questions about any of this before we move on here? Okay. So this is one method by which we can extract cost data or the elements of cost data from the cost data itself. And again, it's record keeping is important. We got to understand what is being recorded. We've got to be able to apply it correctly. So it's important everywhere. This is why accounting is important. Is that we're trying to account for, in this case, costs to allow us to ultimately make business decisions. That's what we're getting at. All right, let's move on to the third objective here, and so we're kind of keeping pace with where we're going to be. We're going to do a CVP income statement to determine contribution margin. So I talked just a bit about this on Monday and what this is. It's not quite the same as gross profit that we know as a GAAP concept, but it's pretty similar. And in some ways, I think a lot of people confuse these two. Contribution margin is a little bit different because it's not so much focused on product cost, which is what gross profit is. That is, gross profit is the residual sales minus cost of goods sold, which are all product costs. Instead, what it really seeks to do is split apart fixed and variable costs. That's really what's going on in order to determine a lot of things, notably things like break even. So let's get into it. I know we've only got about 10 minutes, but we can do what we can today. I think the clocks are correct. So, all right, CVP, again, is the change in, or the study of the changes in cost and volume and how it might affect the company's profit. And again, this is a lot of what we're doing. Why are we doing all this? We're trying to make decisions. We're trying to do planning and forecasting, and which we really refer to it as a budgeting process. And budgeting is very often associated with forecasting. I think managers don't always know what's coming down the road. And clearly there are sort of shocks to the system that they can't foresee. natural disasters. COVID was a huge shock nobody saw coming. But to the extent that they can forecast and determine what they think is coming, then it all ties into a very formal document that we call a budget, or a series of documents. We're going to be getting to that a bit later, but it's important in terms of profit planning. Profit planning is simply the idea of how do we maximize profit, because that's what we're here to do, and we get there by determining good budgets. And so one of the critical factors here, setting prices is oftentimes a useful means, it's sort of a useful outcome of CVP analysis. Also, and I've said this before, do we do more of one good, make less of another good? Do we introduce a new good? In other words, how does this affect our product mix? And this is important because I think up to this point, we've sort of talked about the fact ABC company makes one good, that's it. They make catcher's mitts, and that's the only thing they make. What if they make first baseman mitts and regular outfielders mitts? Those are different products, and so do we do more of one, do less of another? What's the demand for these, etc.? Does it cost us much differently to make a catcher's mitt versus another? I'm talking about baseball mitts here, and whatnot. And so as a result, the question is, do we do more of one, less of another? Do we do more of both? Whatever. These are all scenarios that will help to be determined by our CVP analysis. And then also, how do we use production facilities, and should we use them at all? By the way, there's a huge story right now in the business world, and that is this idea of facilities. And I'm not even talking about production facilities, I'm talking about office space. Because of COVID, a lot of people are working from home. And I think workers sort of, companies kind of open the bottle and the genie's out, and a lot of workers want to work from home. And as a result, office space, the occupancy rates are falling dramatically. And so companies are struggling with what to do with all this space. And is it going to change anytime soon? I don't know that it is, because of the fact that a lot of workers are still working from home. And yeah, I know, believe me, I'm a big consumer of business news. And yes, we hear companies like I think Amazon, or no, Dell Computer ordered everyone back 5 days a week. Can't stay at home. You gotta get back to work. We hear these stories, but the reality is a lot of workers are working remotely, and there's just an excess of facilities. And if in the service business, your production facility is your office space. And so if it's not needed, what do we do with it? And we're seeing rental rates for commercial property just falling. And so it's a really interesting sort of thing that's going on right now. So I think it's important for us to realize that these are not abstractions, these are real things that go on, okay? So these are all useful issues here. So this is a little bit of a complicated slide. It's not my favorite. Where we talk about some volume of doing something and react to the selling price, and we're trying to determine cost. Remember, cost per unit, the variable cost that is more or less fixed and constant in the short run, and fixed costs are also fixed and constant in the short run. So if you take revenue, which is quantity times price minus costs, it will determine profitability. From there to the sales mix. I don't know that we're really learning a lot from that particular slide. So I think a better way of looking at this is by kind of zooming out a little bit here, and because we're bringing revenue to the picture here, and this is not some sidetrack, this is where we're going to be kind of going. And it's kind of this. I'm going to erase, this was a previous problem, so I'm going to go and erase this. And I'm going to talk just in very general terms about what the relationship is here between, and some of this is fairly between revenue and cost, and some of this I think is relatively understood. And if you're taking microeconomics, this is probably all relevant. But what is total revenue? Okay, total revenue we're going to say is also known as sales, right? We might see it as sales on the income statement, or it's also AKA revenue. In this case, TR is total revenue. And it would be very, very nice if we just agreed on one word for one concept, but we can't bring ourselves to do that for whatever reason. And so what do we got going on here? Well, in all cases, total revenue is the price of a good times the quantity of those goods. This is not This is not particularly challenging stuff. In other words, you've got a dollar figure multiplied by a number, and again, it's going to give us a dollar figure. Revenue is always expressed as a dollar figure. Okay. All right. And that's really what's going on here. But that's not really the full question here, because we have a total revenue, because we're not really existing to create revenue. And I know this is not always what people think, but we're at the end of the day, we have to remember that we're out to make a profit. So we have to focus on what profit really is here. So profit is, and again, we have different terms for this. We have AKA net income, or AKA earnings, right? Again, we can't be content with one term. We got to have a bunch of different terms. That's profit. And it's simply the difference between total revenue and total cost. Okay. And these are all dollar figures, total revenue minus total costs. And the way to kind of look at this is revenues are inflows and costs are outflows. And inflows and outflows are what? These are dollar inflows and dollar outflows. And all of these are expressed in terms of dollars. So that's essentially what's going on here. And if you want to take this one step further, you can simply say profit is equal, this will be the final sort of elaboration, is total revenue minus total revenue minus total revenue. Total revenue, which equals price times quantity, minus total cost, which is fixed cost, plus variable cost. Okay. And that's what's really going on here. Price times quantity, which is revenue, and fixed cost plus variable cost. That's profit. Profit or income or net earnings or whatever you want to call it. And for right now, let's not worry about tax. Tax is an issue that is we can deal with on another occasion. Okay. So that is expansion of this entire profit picture. Total inflows, total revenue minus total costs, which we've already said are fixed and variable costs together, added together. Okay, that's the simplest way that we can see our way to sort of explaining what those are. Okay, all right, we've got just a couple minutes here, and I want to sort of move on just a little bit here and talk a bit about some of the basic assumptions. This will be a pretty good. Oops, so I'm going to bring the screen down. This will be a pretty good jumping off point for Monday. So when we talk about some of the assumptions that we have to make when we're doing cost, volume, profit, is we're saying that they've got to hold, otherwise it's not accurate, and you're going to have errors and all that. So these are some assumptions. These are, in other words, conditions by which these relationships have to depend in order to be accurate. Number one, the behavior is relatively linear throughout the relevant range. That is, variable cost per unit is linear and fixed costs are linear. If they change, then we're moving into a different relevant range, and so which we can deal with, but it's we're moving from one short term to another short term. Two, that they can be classified as a variable or fixed. Three, that these are the only factors that are involved are activity level. In other words, quantity, that there are no real unit cost changes. So no changes in labor costs or materials costs, which would affect variable costs. And if it affects variable costs, then we can't assume it's a linear relationship anymore. And then we're also assuming there are no real price changes. And price, again, we're going to come back to that a bit later. Price is obviously the price charged for the good to the customer. And then furthermore, all units produced or sold, there are no inventory buildups or drawdowns. And then finally, when more than one type of product is sold, the mix will remain constant. That is the percentage combination of one good in relation to the other is there. And I think this is these are some important assumptions, and this is really a big one here. As the change in activity is the only factor, that there are no unit cost changes, and that's not always a given. And this is what makes life difficult sometimes for managers, and that is the idea that costs do change. If you're a trucking company, for example, since we're on the subject of trucking companies, fuel costs can change overnight, overnight. And they go up, they go down, and that means unit cost changes, and that makes for some complicating factors. wages can change. We've seen wages being rising lately, and so as a result, that's an issue as well. So anyway, any questions before we wrap it up for this week? All right, when we come back on Monday, we will pick up from here. We're in the third learning objective in this particular module, and I want to try to get through the rest of this content and then move on to some of the examples and questions from the back of the text. So if you do have questions, feel free to get with me. Otherwise, have a great weekend, and I'll see you next time.